Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Monday, March 30th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. We were up 3.35% today on the S&P 500 and closed at 2626.65. The two blue lines you're looking at here are the 2350 support area and the 2600 area that has been acting as overhead resistance. And this is a 1 month, 1 hour chart. So each candlestick represents 1 hour of trading in the S&P 500. And what we can see here is we finished right at the highs of today's session. And on this chart, one of the things I want to point out is that up until today, we had only had 2 hourly candles that had closed above this 2600 level over the last 12 trading sessions. And now today we had about 4 of those, okay? So I'm not trying to say this is overly bullish. I'm just pointing out the facts here. That's on the hourly chart. Now let's move back to a daily chart. So this is a 1 month chart. I wanted to keep it really focused so that we could really see what's going on, and each candlestick represents a day of trading in the S&P 500. And then on this chart, you can see that we've had 3 closes above this 2600 level in the last 12 trading sessions, okay? So yes, in the short term, that is really good news, but a couple of things just to keep in mind, okay? Number one, all of this has happened on the back of trillions of dollars of stimulus from the U.S. government. So promises of trillions and more to come. And then also keep in mind, guys, that this is coinciding with quarterly rebalancing of portfolios. So anybody that has like a 60-40 or 70-30 type portfolio, and with equities falling as they have over this last month or so, what's going to happen is there's going to be money rotating out of bonds into equities. So that is increasing right in here, and that always happens at the end of each quarter, all right, on these 60-40, 70-30 portfolios. Also, anybody that's in an age-based portfolio, okay, anything like that where you get these quarterly rebalancing and you get a drop in equity prices, money will then rotate out of bonds into equities, creating a short-term increased demand for equities. So the question becomes, what will this look like after tomorrow's session? Tomorrow is the end of the quarter, so will the demand for equities be sustainable for the balance of the week and then into next week? So only time will tell, but just keep in mind that this rally here that we've had since March 23rd has been on the back of the stimulus and then that increased demand for equity. So the question becomes, is that sustainable? All right. So let's move on to a 7-year weekly chart where each candlestick represents 1 week of trading on the S&P 500. And again, these blue lines here, this is the 2350 level, the 2600 level, and we can see here this 2600 level, and again we closed just slightly above that today at 2626.65. But this 2600 level, you can see, is a pretty important area of support, and has been at a support and resistance level going clear back to the latter part of 2017, as you can see right here, all right? And then this 2600 area acted as an area of support throughout much of 2018. So it will be very critical if this is sustainable, and if we are seeing a V bottom in the markets like we had right here. What we will want to see is we'll want to continue to see the markets continue to climb higher and not roll over and go backwards, okay? So the difference here is this was, we didn't have near as much going on. We didn't have near as many things against us back in 2018. So a lot of people are comparing this to 2018. But guys, when you look at the global macro environment, this is a much more serious situation. We have a whole lot more going against us here now, right now in 2020 than we did in the latter part of 2018. So I think it's questionable that we can see a V bottom here. But I'm just pointing out the facts here that if this, if we have put in the bottom and if this is going to be sustainable, we're going to want to just continue to see week after week after week of higher closes with maybe, an interruption here or there, but we're going to want to continue to see this go up. And also keep in mind that anything over 2,600 here, you're going to start to run into overhead resistance as the people that put new money to work back in these areas where you see my cursor moving. A lot of times the psychology is that they're scared and they just want their money back, right? So that is a reality also anytime you're trading underneath, right? Anytime, whether it's a stock, a sector, the whole market, like the S&P 500, anytime you have a situation where you're currently trading below previous highs, previous areas, then those areas always act as overhead resistance. So that could be a factor going forward. Now, if this rally is not sustainable, this bear market rally that we're obviously in and have been for a few days, if this is not sustainable and we roll over, then this 2350 area will need to hold. Again, 2350 was where we bottomed right at that area in the latter part of 2018. The first time we got above 2350 on the S&P 500, as you see here, was back in the latter part of Q1 of 2017. So there is some support and resistance at this 2350 level, but I think you can see why this is so critical. If the 2350 level does not hold, then I think a realistic expectation is we need to expect to find ourselves somewhere down here around 2,000 in the S&P 500, plus or minus maybe 100 to 125 points. So I've got the annotated lines at 1,900 and 2,100 on the S&P 500 with 2,000 as the midpoint. As you can see here, we had about 2 years of trading in this range from 1,900 to 2,100 from mid-2014 to about mid-2016. So this is a very, very thick area of support. But again, if we roll over, if this 2350 level does not hold, then we will, I believe, find ourselves down in here in this 2,000 level, plus or minus maybe 100 points, okay? So we need to be aware of that. Now, the next chart I want to show you, and this piggybacks on what I did on Friday. So if you haven't seen Friday's video, go out to my YouTube channel, just Rodney E. Constable, just search that in YouTube. Go out to my channel and check out my video from Friday, okay? This is where I compared the Russell 2000, the U.S. small caps, to the S&P 500 over the last couple of years, and I pointed out that the Russell 2000 peaked in 2018. And so kind of piggybacking on that idea and to kind of maybe address some of the comments that people have been leaving on some of my videos talking about they thought the economy was so strong and maybe the global markets were so strong, I thought it would be important for you guys to see this chart. Now what we're looking at here is the MS World ExUS Index. And what this is an index that captures large and mid-cap stocks across 22 of 23 developed market countries, excluding the U.S. So basically, it's an index, all right, that we can use to kind of track what's going on across the world, minus the United States. There's over 1,000 holdings in this thing. It covers, again, large and some mid caps, and it covers approximately 85% of the free float adjusted market capitalization in each country. Again, 22 large countries are represented. All right, so it's very representative of what's going on in the world outside of the U.S. And what we're looking at here is a monthly chart, and I brought this clear back to the inception of this index, which goes back to 1994. Okay, now this blue line I just put at the 1550 level. We're slightly below it right now. We closed at 1534.36 today, and so I just put the line at 1550 to kind of show that where we're at now, we can go clear back to, guys, 1999, okay? So anybody that bought and held something like this product, there's a couple of different ways to think about this. Anybody that bought and held this, they haven't made any money in over 2 decades, okay? Said another way, outside of the U.S., when you aggregate all of these stocks, all right, this index hasn't gone anywhere since 1999. Okay, since before the beginning of 2000. So that is a long period of time. Now we've below it, above it, and everything. But also another thing to point out is that this index peaked in 2007. We never regained the high. Not only are we down to trading where we first crossed above this level, this 1550 level back in 1999. But guys, this index peaked back in 2007. And we never regained those highs. So it addresses multiple things here, and I'm not going to spend, I could spend an hour just on this one chart, and I'm not going to do that here, but I just want to bring your attention to the fact that what's really been working, and each day I'll take a look at a different chart here to kind of make my point, but what's really been working, especially in the last couple of years, has been the U.S. large cap companies, okay? Small caps have underperformed. The rest of the world, to a large degree, has underperformed. Most country ETFs have underperformed. And so it gave us the illusion, especially if we're just looking at the Dow or the S&P 500, it gave us the illusion that everything was great. But that's why I want to educate you guys on the fact that everything hasn't been wonderful outside of the U.S. large caps for several years, if not longer, okay? So just keep it, keep that in the back of your head, but also think about this from a diversification standpoint. Everybody says, oh, you got to be globally diversified. Well, diversification is great, but also remember two things. Diversification reduces stock-specific risk. It doesn't help with systematic risk, which, by the way, that's what my Simple Market Signals system deals with, is systematic risk, okay? But when you diversify outside the U.S., you probably want to make sure that those areas you're diversifying into are performing well, right? Being globally diversified doesn't mean your portfolio is going to perform better. And the global markets are so highly correlated these days that the diversification, owning equities outside the U.S. won't necessarily help you in a downturn like this. In a systematic event like we're experiencing, you can experience, these kind of downturns across the entire globe. And so owning equities outside of the U.S. does not really help you in these types of environments. So just a couple of data points here, but remember again, just to kind of recap, this index peaked in 07. Again, this is the MSCI World ExUS Index, and peaked in 07. We're, at this level that we're trading at now, we first traded here over 20 years ago, guys. Okay, so all isn't rosy. And the problems in the global marketplace aren't just about the coronavirus. So I just want you to think deeper about this. And again, if you haven't seen Friday's video, go out and check that out. That's where I did a very similar chart, but I looked at the Russell 2000 over the last few years here in the U.S. And of course, if you haven't already subscribed, please do so while you're out there. Check out some of my other videos, and I have just a couple more data points for you before you leave. All right, so let's talk about a few points to remember. First off, we've been experiencing quarter-end portfolio rebalancing here over the last few days, and this will more than likely extend into tomorrow, the last day of the first quarter of 2020. So we've had an increased demand for equities, over the last few days, and of course that has coincided with the promise of a massive stimulus plan, multi-trillion-dollar stimulus plan with more to come from the U.S. government. So the question becomes, what does this do to the demand for equities after quarter end? And none of us know that answer for sure. But just considering the most basic economic principle of supply and demand, the question is, what will the demand for equities be after tomorrow's session, after the quarter end, after Q1 of 2020 is behind us? So we'll have to keep our eye on that. Also, guys, remember, there is still a lot of unknowns in many, if not most, areas of the stock market, the global economy, the global macro situation. There's a lot of moving parts, and this is bad, guys. So don't underestimate the severity of the situation. There's still so many unknowns, and there is a high potential for a negative feedback loop and the domino effect that comes with that. I've been through this before in the 2000 through 03 bear market when I was working for Oppenheimer Funds, the mutual fund company, and it just seemed like every time we were starting to climb out of the negative environment, something else would happen. So I've been through this where it lasted multiple years. I'm not saying this is going to last multiple years, but we can't discount the fact that we are in an environment where the negative feedback loop is real, and we could experience one domino after another falling, and it's hard. Once you get that momentum going against you, it's hard to turn that around, okay? So don't discount the probability of that happening.